Good morning, everyone. Thanks for joining us on another of our Pulse webinars today. We're just opening up the room and there's lots of you that have dialed in this morning, so we're going to make sure that everyone gets dialed in before we start. But thanks again for joining us. It's been a very popular topic, as I'm sure you can all imagine. AI at the moment is all over the news. It's extremely topical. So I'm very looking forward to hearing Chris's presentation today. So we'll just get the room open to get a few more people dialed in, and then we'll start with today's presentation. Thank you. So this morning, what we'll be talking about is the future of investing. And we've got Chris Saunders, who's very passionate about AI. I think that's fair to say, isn't it, Chris? And looking forward to hearing your thoughts on AI and how your views on AI are shaping your portfolio picks and choices, and how people should be really thinking hard about how to include AI in their portfolios and future investing. So the format of today is Chris is going to present his slides over about 25 minutes or so, and then at the end we'll have a Q&A session for around 10 minutes. So you'll have your chance then to pose any questions you have around the topics that's covered today to Chris, and we'll be able to answer as many of them as possible. As always, this session is recorded, so you'll receive a recording of it. We'll also share the slides with you, and you'll get all of those in your inbox afterwards. And then obviously, if you do have any other questions, like to know anything else, then you'll have Chris's contact details to reach out to him. And what we've done today as well, we've just popped in the chat that you should be able to see a link to our LinkedIn, and on there, that's where you'll see all the future Pulse webinars, any news and updates from a Novia global perspective. So if you haven't already followed us on LinkedIn, I'd really encourage you to click on the link attached in the chat, and there you'll see all the upcoming webinars that we've got you will be able to register, and all the news on Novia Global. So have a look at that when you get a second. But for now, I think we've got quite a lot of people dialed in, so we're ready to go. So without further ado, I'm going to hand over to Chris and to today's presentation. Thanks very much.
Hopefully you can all see the presentation slides there. Linda, can you confirm that?
Yes.
Yeah? Wonderful. Okay, thank you so much. Thank you very much to Linda and Novia for the opportunity to present you today, and of course for you viewers tuning in. For those of you that don't know me, my name is Chris Saunders. I'm a chartered investment manager and co-founder of New Horizon Asset Management. The key topics for us to cover today, as in the invitation, will be beyond traditional asset allocation, why megatrends, not conventional diversification, we believe will shape investment success moving forward. Also, the need to gain exposure to innovation. So not just AI, but AI and tech disruptors must be a part of a future-focused portfolio. And then, of course, the rise of AI-powered investing and how AI is revolutionizing stock selection and portfolio management. So firstly, I want to set the scene in terms of asset allocation. So I first presented this slide probably around, actually 2022, 3 years ago. I think it's quite a useful slide. So if we focus on asset allocation to begin with, we think that the investment world is transforming, okay? And this is raising questions about how to build portfolios. Now, why are things transforming? AI, topic of conversation today, innovation in general, but also geopolitics. So it now calls into question many sort of long-held investment principles, including the idea of a neutral benchmark portfolio, like the traditional 60-40 portfolio mix of stocks and bonds. So what is this chart showing me? So I get excited about charts, so bear with me on this. You're probably not as excited as I am. But these dots, okay, represent global equity returns and global bond returns since 1977, so almost 50 years, okay? So we're going to go to this first dot, 1982. The reason we go in 1982, because believe it or not, that's when I was born, Okay, so it was a great year, obviously. We're getting lots of comments now in the chat box stating, don't actually believe he was 1982. It's the truth, honest. Anyway, 1982 was a great year, not just because I was born, but because global bonds, and hopefully you can see that shaky line, global bonds were up around 33%. That's that bottom axis. And global equities, that's a very wobbly line, were up 10%. So 1982, fantastic year. Bonds and equities as part of a 60-40 portfolio did very, very well. But let's look at 2008, global financial crisis. Equities down 40%, as we all know. Bonds down up 5%. So what I'm trying to present here is that in difficult times, the reason that we build a portfolio, one of the central tenets of portfolio construction, is decorrelation or diversification by putting assets such as bonds and equities together. So another good year, difficult year, 2002, dot-com bubble bursting. Bonds up 15%, equities down 20%. Okay, so again, bonds cushioned the fall of equities. That's what they should do. Let's go in the last 10 years. 2015, bonds down 5%, equities down 5%. 2018, similar story, bonds and equities down. 2022, bonds down, actually ended around 20% down on the year. Equities also down 20% plus. What I'm trying to say to you is I'm trying to highlight the differential or the breakdown in asset allocation. Before, putting a 60-40 portfolio together was because of the decorrelation and the diversification between global equities and global bonds. But it appears that we're almost in a risk-on, risk-off market because in the last 10 years, 3 out of the last 10 years, and 3 times out of the last 50 years, we're seeing both bonds and equities down in the same year. So does this traditional portfolio work any longer in portfolio construction? So hold those thoughts, okay? If we then talk about traditional active fund management. So when I first started, active management dominated the equity investment landscape, okay? So 20 years ago, in 2007, active management, you would see 80% of investments or equity assets under management would be held by active managers. Just 20% invested in passive strategies. Fast forward 15 years later, and over 60% of US equity assets under management are now in passive strategies. Why? Well, look, over the last 20 years, again, this risk-on, risk-off nature of the market, only 7% of active fund managers actually outperformed the S&P 500. And what we have seen in traditional active fund management, I'm going to be a little bit controversial here, but what we have seen is that many so-called active managers simply mirror the market, with less than 50% truly active positions, offering little more than an expensive index fund with a good story. All right, so a little bit controversial, but if you actually look at investment returns, when you weigh up costs, it's a really difficult sort of position to be in to sort of go active over passive, certainly in the last 10 to 15 years. So coming back to the conversation around asset allocation and coming back to the conversation around active stock selection, when we look at asset allocation, because of this erratic correlation between stock and bond returns, which has defined the new regime, which is what those dots, which I got very excited about on the first chart, were about. Government bonds have become less of a reliable cushion against equity sell-offs. So that's what we saw over the last 10 years. So what we're now seeing is the potential for other diversifiers. So what other diversifiers could we be looking at? The first one is old diversifiers such as gold. Okay, now we've seen stellar returns which are incorporated within all of our model portfolios for gold exposure. But what we're also seeing, which is what this chart identifies, is that we're now seeing more innovative assets such as Bitcoin step in. So this is not about replacing long-term bonds to find diversification, but instead seeking new and different sources of risk return. So again, along the sort of innovation story, Bitcoin, believe it or not, has the potential as a new diversifier. Okay. Now, I don't think we're there yet for most investors, but in the US, with the introduction last year of the numerous Bitcoin ETFs, Ethereum ETFs, we're now starting to see this alternative asset class be included in portfolios in the States. Okay. We include blockchain technology within our overall multi-asset portfolios to a small extent, not Bitcoin itself, but this is super interesting. Why do I find this chart interesting? Well, I find this chart really interesting because correlation, which is what this red line with equity returns, is now just 15%. And what we have seen since 2014 is the volatility of Bitcoin has reduced. Now, I'm not saying that it's not a volatile asset. It is, which is why you position and allocate accordingly. But decorrelation, diversification, and correlation with equity returns is becoming lower and volatility is coming down. Okay. Now, this stems from, Bitcoin's unique value drivers, the potential, of course, to appreciate over time, because as you all know, or probably should know, there's a predetermined supply. And then when you've got growing demand, obviously the share price or the Bitcoin price, of course, goes up. And there's a sort of widely sort of it feels as if now with Trump in the White House that there's a sort of pro-crypto sort of lobby there. So absolutely. Also, the potential for Bitcoin to become more widely adopted as a payment technology. I don't actually believe that myself. I think it's more potentially as a store of value. But either way, these distinct or different drivers make it less correlated with stocks and other risk assets in the long term. So that's one way to look at new diversifiers. The other way, which is probably what we're here to discuss in depth today, is actually redefining how we think about asset allocation and think not just in terms of asset or redefining how we think about traditional portfolio construction and how perhaps we think along lines of themes or megatrends as opposed to asset allocation. So I'm going to try and explain this now. For decades, economies have followed stable long-term trends, right? And as this chart or this slide shows, the world is shifting away, as we've seen. And I don't think I've mentioned Donald Trump's name yet, but there you are. It's done now. The world is shifting away from stable trends. Why? Mega forces such as AI, energy transition, geopolitics, they're now starting to redefine growth. So investors, or as a macro investor years ago, right, through time, you could focus almost entirely on navigating your investment or your asset allocation as economies followed stable long-term trends. So what you would do, you'd almost focus entirely on navigating any temporary deviations around these trends because growth would eventually converge back to its trend. So that's been a foundational tenet of portfolio construction. Arguably, the investment or the environment is now very different because economies are undergoing a massive transformation that could keep shifting the long-term trend, making a wide range of very different outcomes possible. Okay. So what's driving economic return or economic growth may look very, very different. So mega forces could fundamentally reshape economies. So AI is obviously one mega force, energy transition to a carbon neutral world. But if you ask me, I think if you're looking at anything over the next 5 to 10 years, one nailed on mega trend is, of course, AI and artificial intelligence and innovation. Now, why this is important, not just alongside, thinking about trends in terms of, over asset allocation or blending, is there's a real resonance of mega trends with investors. What do I mean by that? Well, if I'm a financial advisor and I'm speaking to my clients, people or clients connect with stories. Megatrends are powerful. As Linda said at the start, okay, these are really salient sort of topics at the moment. Perhaps that's why we've got so many people registered today. I feel a little bit under pressure. But in seriousness, megatrends are powerful real world narratives that people can connect with. So like past revolutions in transport or healthcare, megatrends do shape the future, and investors can understand or can feel the world around them, and they want to gain that exposure within their investment portfolios. So as I sort of touched upon, the only megatrend that is nailed down as far as I'm concerned, and that's what we're here to talk about, is AI, is innovation in general. So I've stolen this chart, okay? It is sourced, and you'll get the chart later, but I've stolen this chart from a rival investment manager, and she's excellent, I think, in terms of conveying her thoughts. She's quite volatile in terms of the portfolio, so we steer away from it. But this particular chart identifies, or if you like, identifies the impact of innovation over the last 250 years. So all of these dots, and I've told you I get excited about dots, okay, you've got your steam engine 250 years ago, the impact of innovation, the impact of the steam engine on the global economy, on industry, on society was obviously huge. You go back to the 20th or the dawn of the 20th century, telephone, automobile, electricity, the impact of innovation was enormous. Arguably, the impact of innovation around 5 different innovative platforms. We're on the precipice of the global economy undergoing the largest technological transformation in history. Okay? Because you've got energy storage, AI, robotics, genome sequencing, blockchain technology, all of these 5 platforms that are essentially merging and transforming at the same time. So look, AI, of course, is one of those platforms, and AI, if anything, is driving those platforms, but they're all driving each other on, if that makes sense. So what do I mean by that? Well, look, the developments in AI, or the developments, better example, developments in big data, okay, or developments in energy systems allows us to analyze big data, which then, of course, allows us to have these huge models in terms of artificial intelligence and AI. So all of these platforms are building on each other. And essentially, we're going through, I believe, not only the largest transformation in history in terms of the economy, but industries and arguably society. Because what we are now seeing, and I'm not going to dwell too much on the numbers here, because this could be a boring slide, but we are seeing exponential growth in all of these industries. So whether you look at artificial intelligence and the market size, okay, the market size from 2022 to 2032, is going to grow 5-fold at least. Robotics, the same. Cybersecurity, cloud computing. And a lot of people are asking me, what do you think, Trump, tariffs, all of this short-term volatility? Short-term volatility. Because innovation is what is driving markets as far as I can see, certainly within the US. And because innovation is not dependent on the direction of macroeconomic developments, this also means, as far as I'm concerned, clients need exposure to these platforms, okay? Because what we're seeing is exponential growth. So I'm going to try and explain this without not getting too sort of techy or too sort of in depth here to keep you interested. But exponential growth is a pattern of data that shows greater increases with passing time. So then you see this curve here on the left-hand side, which is exponential function. And there is something called Moore's law. So work with me on this one. Moore's law is an observation that the number of transistors on a microchip roughly doubles every 2 years, whereas over the same time period, the cost halves. So when you see key costs coming down and performance breakthroughs, what do you get? You get major demand growth. So whether that, a good example might be years ago, when you wanted to buy an electric vehicle, they would be very, very expensive, and you couldn't drive them past the end of your street without having to charge them. I'm obviously, exaggerating there. But of course, you look at the prices now of EV, and you look at the development in their technology, and of course, there's major demand now. They're much more accessible. And that is the same across pretty much every platform. So using things like, we've just recently seen, the costs of sort of AI and exposure to AI come down in price, and the computing power. So what we're essentially seeing is that innovation is breeding innovation, and we've got this exponential platform effect. Some of the areas that we invest in, I'm conscious of time here because I've actually been speaking for 20 minutes. I've got quite a few slides left, but we focus on AI, energy storage, robotics, and fintech innovation. And as you can see from this slide, you've got loads of underlying exposure, or loads of underlying industries that we think are going to dramatically change over the next 10 years. So cloud computing, streaming, Internet of Things, autonomous mobility, 3D printing, cybersecurity. I'll not reel them off. You can read them yourself. Okay, so I'm going to move on to the third part, or the third topic now, of the presentation, which is, hopefully I've now convinced you entirely that you need to sort of think along lines of themes rather than asset allocation, or blending themes with your asset allocation. Okay, hopefully now you've bought into that in terms of you ensuring that you invest in AI or innovation as a mega trend. But how do we do it? Because arguably, just by investing in the S&P 500 or NASDAQ tracker, you are gaining exposure to these themes. Why? Because both in the US and world equities are now heavily concentrated in just 7 US mega cap tech stocks. So Apple, Amazon, Alphabet, Microsoft, Meta, Nvidia, and Tesla. Okay, I always test myself under pressure that I can remember all 7 of them. And luckily I did. But especially Nvidia, Microsoft, Alphabet, Meta, and Amazon. Now, they've grown to such an extent due to AI capability and infrastructure. So this chart shows how quickly economies and markets can be transformed, because the Magnificent Seven, those 7 stocks, now have a market cap share of the S&P 500 of over 30%. 30%. And you can see since 95, which is what this chart shows, to 2024, how the market composition has transformed. Okay, so what I'm trying to say to you is that we've now got this massive concentration. So actually gaining exposure to AI is quite easy. You just go passive. But this is actually becoming a bit of a problem because of the rise of indexing, so ETFs, tracker funds. This means that these stocks, which have gained in momentum, as we saw in 2024, so 2024, which is what this chart shows, was the narrowest band of equity returns. Really, if you didn't hold the Magnificent Seven, which were up 167%, if you didn't hold those stocks, you didn't perform very well. And what we've seen due to indexing and due to passive investments is that we're seeing these ETFs have to allocate in line with market movement. So let me try and explain that. There's one ETF, for instance, called a Market Vectors Semiconductor ETF, okay, which again is an AI-focused ETF. Nvidia exposure pretty much jumped overnight from 6% to 20% because the ETF has to allocate in accordance to the market capitalization and the movement of that stock. So these things are becoming self-fulfilling prophecies, if you like. Stocks moving upwards, ETF follow it, and of course the reversal happens. And why I'm making this point is that this concentration risk is seeing increased volatility, and we are seeing on a daily basis billions being knocked off the value of the stock market. So what we are seeing on this chart is a really good evidence is that this is the MSCI World Index now, okay? MSCI World Index was up 20% last year. You take out Nvidia alone, that shaves 5% off. Just one stock. You take off the top 10, which are all US mega cap, you take off 10%. So how do we get this diversification? What is happening is that diversification is almost dead because we've got such a narrow band. So because of this problem that's created over the last 15 to 20 years with all of this sort of passive investment, you would think surely this is now going to reverse, and this is now finally the time for traditional stock pickers to shine and reverse the trend, right? So active managers should be rubbing their hands, licking their lips, thinking, right, here we go. We're going to reverse that trend of losing market share and outflows from active management into passive management. Let's reverse that trend because now we offer diversification. I don't believe that's the case. Because, in my opinion, traditional active management has simply, there's such a bias to mega cap that it's very, very difficult to actually see whether traditional fund pickers can add value, and which is where we come on to why I think AI-powered investment will take over. So what do I mean by that? Look, first of all, NASDAQ composite, 55% exposure in the mega caps. A mega cap company is a company over 200 billion. S&P 500, 45% exposure to mega cap. Traditional active tech manager, same. Why? Nobody really wants to veer away from benchmarks. Once you veer away from benchmarks, you add too much active share, you lose assets. Simple as that. The way that we manage assets, we have a much more broader global universe of stocks, which means, look, in this example, we only have 17% exposure to mega cap. Last year, we only had 3%, which was a really wrong call by the robot because you only wanted mega cap. But that's how this works, because we have exposure to mid cap, small cap, or mid cap, small cap, and large cap. So what I'm trying to say to you is that I still don't believe traditional active management will offer you the diversification that is needed. Why? Again, let's talk about this traditional innovation manager here. On the right-hand side, there's I'm not going to name the manager, but it's a brilliant manager, far more intelligent and qualified people than I am. Armies of analysts, 97 stocks within their fund. The top 10, okay, 8 of those top 10 are in the top 10 of the NASDAQ. All right. This middle, which is this left-hand table, this middle table is an innovation passive index. 1, 2, 3, 4, 5. Is that 6 or 7? 6 out of 7, 6 stocks, again, in this innovation index are also replicated within an active manager's portfolio. What I'm trying to say to you is that whether you're looking at global investments or whether you're looking at technology, everybody holds the same stocks. Okay. And everybody largely is weighted to Magnificent Seven and mega cap, which is companies in excess of 200 billion. Why are we different? Okay. Or how I should say, how do I believe AI investing is the answer to true active stock selection and diversification? The first reason I think that it is consistency. Now, the great thing about AI-powered investing, regardless of what we do, okay, the great thing about AI-powered investing is that it sticks to a clearly defined process. Once the process is created, that's it. So in the case of the New Horizon Global Innovation Fund, we have 36 equally weighted stocks split over 4 portfolios. The 4 portfolios are value, growth, quality, deep value. 9 stocks in each. All right, so we're not going to name these 9 stocks, okay? But this is really, really important. If a stock out or underperforms over the investment period, it's rebalanced automatically, okay? Now, why is this important? Well, I think, first of all, this is important because you can't veer away. You can't get emotionally involved and talk to the management and allocate, you know. You look at Fundsmith, brilliant fund, brilliant manager, 10% in Novo Nordisk, 10% in Microsoft. You've got that concentration risk. We can't do that, okay? Terry obviously has done extremely well. It's just not what we do. But also what we can do with AI-powered investment, and this is not just New Horizon in global innovation, but in general, you have scalability, as essentially AI can analyze huge volumes of data. So AI is able to analyze hundreds or thousands of stocks in an investment universe. So look, we look at mega cap, large cap, mid cap, small cap. We cover 47 markets. The investment is made from an investment universe of over 500 stocks. All of those stocks are including, are stocks which hold or have exposure to AI, robotics, energy storage, fintech. Okay, so consistency, scalability, but also objectivity. And I'm talking in general terms, not just New Horizon Global Innovation, but AI-powered investment offers this objectivity because there is no active manager speaking to management or going overweight positions, okay? It's simply an analyzing of the data. So I'm going to try and explain to you now how our AI system works. And I'm sorry I've run over the half hour, but I'll be as quick as I can. There's only a couple of slides left. So our AI system or our AI-based stock selection is causal, which means it learns on the job. All right, and it learns which elements are having more weight towards stock selection or stock price movements. So let's look at this left-hand side box here. Okay, these metrics, okay, are the metrics that traditional or most traditional active fund managers will look at. They will look at book value, revenue, earnings, EBITDA, cash flow, and of course the share price. That's what pretty much all of the managers look at. So got a nice slide here. So whether it's Terry Smith on the bottom right-hand corner, top right-hand corner, Warren Buffett, whether it's Cathie Wood as a growth investor on the bottom left, or Benjamin Graham on the top left there, deep value, we're all pretty much looking at the same metrics within reason. Okay. However, our systematic causal AI stock selection system allows you on a daily basis to analyze which stocks are offering the best value. So this means that the difference with causal AI is that we can analyze, and we do analyze on each stock, so each 500 stock, on every 500 stock, on all of those, on each stock out of the 500, we'll have 30 analysts. And we will be analyzing the median analyst forecast for book value, revenue, earnings, EBITDA, cash flow, and the share price. So I think 500 stocks times 30 analysts, that's 15,000 analyst reports on a daily basis over 6 metrics. So you look at 90,000 data points per day. All right. And then from those data points, we're simply gaining a median analyst forecast from all of those fantastic analysts, and then we're incorporating them into a daily dynamic model producing expected return, volatility, momentum, and the implied discount rate. What this essentially means, guys, is then we then see the stocks which offer the best return in terms of being high returns, not excessively volatile, and exhibiting positive momentum. So as you can see, again, objectivity, scalability, and a very robust, repeatable process with no human interaction. What is also fantastic, I think, from an AI perspective, and this isn't just us, but AI will allow you to filter and prioritize different metrics. So within our portfolio, we have these 4 buckets, or these 4 sub-portfolios. We have a deep value portfolio, a value portfolio, quality, and a growth. So we've got our very own Buffett, Terry Smith, Cathie Wood, Benjamin Graham within our portfolio. We have sub-portfolios because essentially AI allows us to use these filters because each of these managers will weigh on different metrics that they find more important. Okay. And we will just use that filter. So rather than employing an active fund manager or fund of funds, we'll simply use a different filter and factor. And why we do this over 4 portfolios is that we reduce the overall volatility and reduce the overall risk. So we said at the start, equal weighted investments, 36 stocks, 2.9% in each stock, really sort of tightly guarded. And then those 36 stocks are divided into 4 portfolios of 9 in line with what the factor or the style of the portfolio is targeting. What this then means is because we are then analyzing the data on a daily basis, we actually have active fund management because we offer real diversified or dynamic active management because we will be rebalancing every 2 months. And there's an anticipated turnover of around 60%. So 60% of the stocks in our portfolio will change. Why? Because we're just pressing the buttons. Simple as that. And this then means, and I've alluded to this chart, is that you get real active management. You don't have these passive active funds. You have a very different market capitalization in terms, as you can see, you have weightings towards mid cap, you have weightings towards large cap. You, of course, include mega cap as well. At one point, we could be 100% mega cap if that's what essentially the system is saying to us. But it's all based on a valuation perspective. Last slide, guys. I've gone over. I do apologize. Our most recent rebalance meant that we actually rebalanced over 69% of the portfolio. So again, offering true diversification, true active management. 83% of the portfolio is not in mega cap. Okay. And we just hold 2 out of the 7 magnificent 7 stocks. Okay. So what I'm trying to say to you is that if I was in your shoes, and I was looking to gain exposure to innovation, passive management, no doubt, has some fantastic merits. I build portfolios with my multi-asset using passive investments, but there are limitations and there are increases in volatility. But go passive. But I wouldn't go passive and traditional, because passive and traditional look very, very similar when you look underneath the bonnet. I would either go passive and traditional, and combine that with AI-powered investment, which, of course, you can all get in touch with me after the presentation if you wish to learn more. Linda, I'm very sorry. I've ended the presentation a bit late there, but I'm very open to questions if we have any in the chat there.
No, not at all. That was really, really interesting. I feel like it probably deserves another slot at some point later in the year, because I think AI itself, the topic and everything that goes with it, is very difficult for you to sort of cover all of those points in one presentation. And I feel the interest we've had in this particular topic is sort of warranted. So indeed, those that are dialed in, if it is something you'd like to have another layer, and we can add another slot into our webinar series on AI, I do think that would be merit worthy, because there's just so much to cover in this topic. And I think your slides covered it really well, particularly at the beginning, about how that's impacting all of our daily lives, let alone obviously from an investment perspective, and sort of looking at it from a different lens as to what we should be thinking about. Now, it's no surprise we've had quite a few questions, so I'm just going to sort of dive in and pick up on some of the threads of some of them. So there's a couple of queries around, your with AI and the way that we look at AI and how that actually works. It obviously takes away some human interaction, some human thought. So, what are your views on the limitations of that? Where could stock selection work from an AI perspective, as opposed to using a human fund manager or your own intuition, if you like?
Yeah. I mean, so first of all, I'm very biased because I don't believe in traditional fund managers, traditional stock selectors, because I've worked with them for 20 years and they've got a wonderful story. And I used to sit next to lots of them, and, they'd have good years and bad years. So I think that AI can only add value to those persons. So what do I mean by that? We don't really know which way this is going to go. Arguably, how it's going to go is that active managers are going to be using AI, and it's almost going to be the best user of AI is going to be the best manager. That could happen. Okay. So it's like a really sort of intelligent, fantastic active fund manager going, look, I use intuition to a certain extent to meet management, but I use AI for all my data analysis. That's definitely going to happen. That's happening now. Okay. Whether the person, the human, will be replaced by AI, so it'll be AI managing AI, I think that's probably what's going to happen long term. I personally think, but that's so far off, and things are changing so rapidly, like you can't keep up with it. Which is probably why when we said at the start about questions, I often get nervous about questions because it's something you can often miss. So I think that to answer your question, AI will form part of a traditional fund picker, a human. I also think that perhaps longer term it'll be AI on AI. Okay, but there's no doubt about it that this is going to add value to the underlying investor, which I think is really, really important.
Yeah, absolutely. A couple of other questions. So aside from AI, tech, the big seven, what other sectors do you have your attentions on? Emerging markets, infrastructure, space, and where are you?
It's a great question. From our asset allocation perspective, Linda, we're quite I wouldn't say innovative, but a lot of multi-asset managers are just bonds, equities, cash. We've always been bonds, equities, commodities, infrastructure, cash, alternative income assets such as specialist property. So from an asset allocation perspective, that's where we're weighted. From a stock selection perspective in terms of global innovation, it's really, really important that people understand that the stocks in our universe are not just tech stocks. So by investing in global innovation fund, you're not just picking, the apples of this world and the tech stocks that we know, but you might be buying companies such as John Deere. Who's John Deere? John Deere is a tractor company, but John Deere incorporate AI within their cultivation. They incorporate robotics, autonomous technology. So that for us is an innovative company, even though it's a tractor company in the agricultural sector. So it gives you an idea of what innovation looks like for us. So it's a very broad spectrum in terms of all sectors that are included within our investment universe for our AI fund.
Yeah, thank you very much for that. I'm just looking through a couple of other questions. There's a few people have asked a bit more detail on what you guys do. So just to confirm to everyone, we'll send everything out. We'll send all of Chris's details. If you have any specific queries on the funds and the models that the New Horizon run, which are all available through the platform, then you'll get all those details after. One other question I think would be worth asking is with regards to AI and the sort of reliance it has on certain sectors, certain countries. So, for example, Taiwan, if something happened there, either wars or political issues or another COVID starting or something like that, what impact do you feel those sort of key jurisdictional areas could have on AI going forward?
It's a very, I mean, it's a brilliant question. I think something that you've lent into the geopolitics, which we touched upon earlier. Not just Trump, but as you say, China, Taiwan. I mean, to keep things. I mean, tech stocks would get hit hard. I mean, especially anything dependent on semiconductors. There would definitely be a sell-off in the Nasdaq and in Asia, because of course the fear would be over the disruption of chip production. So that's something certainly to be aware of. My personal belief, and you can see this with sort of there's a company called Taiwan Semiconductor Manufacturing, which arguably has priced in geopolitical conflict. So look, there's no doubt about it. Stock markets, if that did happen, if there was any sort of reverberations around Taiwan, they would likely plunge. Of course, volatility would increase. But think of it just like with Russia and Ukraine and the Middle Eastern issue. You do tend to see these geopolitical conflicts contained these days. And I think this is in the minds of all policymakers in terms of making, the US more robust and, other areas of the globe more robust against these sort of potential geopolitical sort of fears. So I don't like to think about these events happening, but of course it's right to bring up these events. You'd of course see a very near term fall, which is what we experienced with Russia and the Ukraine. But I think things, tend to bounce back over a short-term period.
And then I'm just going to round up with just one final question, which I think is quite interesting. So lots of companies are going to be using AI more for their investment selection as well. So rightly so, logically, they'll probably be finding similar conclusions on buys and sells within a similar set of criterias. So what do you think will be the effect overall? Because this could potentially exacerbate movements in those individual stocks. And I think that's a good point if you're all using the same kind of methodology. A
brilliant question. I'd like to know who asked that question. Actually, have to tell me later. Brilliant question. I mean, so just like active managers are all active managers, active AI managers are going to be using different criteria. So you're going to be even though you're going to be analyzing the same data, you're going to be applying that data differently. You're going to be weighing, certainly at the moment, the importance on different areas. So as I sort of touched upon earlier, we've got the same metrics, right? Everybody's looking at the same metrics. They're not. There's different metrics, but they're the main ones. EBITDA, revenue, price to book. We're all looking at those metrics, but we're applying different weighting and different importance on those metrics, dependent to where we are within the economic cycle and dependent on where the stock is within the stock cycle. So that's quite technical and maybe a little bit boring, but the point that I'm making is that everybody will have a different view on that. So our AI partners, so AI is obviously really trendy now, but we've actually been working with our AI partners since 2018, when we didn't actually call it AI. It's essentially an algorithm. But the data set with our AI partners goes back to 2005. It's based on the S&P 500. So, the point that I'm making is that, different data sets will be applied, different data will be analyzed, different data sets will be applied, different weightings. The way that I use the portfolio, our portfolio, is we split between those factors, because I believe, by splitting between deep value, quality and growth, you then have a nice broad exposure to factor and styles. Now that kind of reduces the volatility, but also potentially reduces the returns. So that is a human element, because we have set it like that. Now we've based it on AI data, which is why there's some strong arguments why they're the best factors to use. But ultimately, we have decided that. We have, and that's how this is going to be used, is that there's going to be a human element to decide upon, how we apply the AI, certainly in the short term. The long term, the AI on the AI, I just don't know the answer, basically. And that's the truth of it. Maybe I should have used ChatGPT, actually. It might have given me a better answer. But that's the truth. So there will be different applications, different filters. But that's what makes this so exciting, right? And people like me probably going to get replaced somewhere along the line, right? People like the guys tuning in, the financial advisors, they're not going to be replaced. Why aren't they going to be replaced? Because humans love humans. Human connection is going to come at a premium. So if you're good at sales, which hopefully I'm okay at, depends, we'll see after today, if you're good at sales, but if you're good at, building relationships with humans, that is going to come at a premium. So I wouldn't worry if I was a financial advisor, are you going to be replaced? It's me that's going to get replaced, quite frankly. That's more of the chance. So a little bit of an anecdote there, but hopefully that's relevant.
No, thank you so much. As I say, there's quite a few questions on this, and I do think it probably warrants another session at some point later on in the year, because the topic is just has so many levels to it, and obviously generates a lot of interest, and we're all, sort of sat here wondering, are we all going to get taken over by robots at some point? And, it's a really interesting topic to cover, and obviously it's extremely interesting in the investment sphere and how stocks are being picked and everything that we are investing in at the moment has some element of it in some shape or form. So thank you so much for your time. As I said, the presentation will be sent round to everyone, and all of those that had a couple of queries on the actual New Horizon products and models, Chris's details will be attached. So you can reach out to Chris, come to me directly if you need anything else. Our next webinar will be on the 30th of April. Invites will be going out in our next Pulse newsletter, which will be next week. That webinar will be with Nathan Sweeney of Marlborough. So if you'd like to register, then look out for the invite. And just a reminder, as I said at the beginning, in the chat, there is a link to the Novia Global LinkedIn page. We would love it if you would all click and follow, and you get all the latest details. And we share lots of different content from all sorts of different providers that we work with. So you'll get a good wealth of information on there. But all that remains is for me to thank you so much for your time. Thanks for everyone's participation in the questions as well. It's made for a really interesting topic today, and hope you enjoyed it, and we look forward to welcome you all next time. Thanks again, Chris. Thanks, everyone.
Thank you, Linda. Thank you, guys. All the very best. Bye-bye.